Turkey did, and there was another country did, and I can't remember. There are two countries reported that I saw. And what's happening is they're selling the gold because I think financial insolvency. Turkey's the third largest gold market by trade in the world, just flows. And so gold has always been a part of the people and the government. And so it's an asset that they will sell off if they need liquidity. And so the Turkish economy is a good one, but it's had its own troubles. They've had some inflation in their currency and things like that. Selling the gold can help them deal with that situation. So what happens is when you sell that much gold in the market, it does create physical liquidity, and it can, in the eyes of traders, convince them that the price is going to go down. So they may do some more short bets, but it doesn't, when they sell it, it doesn't necessarily come across the COMEX. So it's not a cause long-term. It really is. If you think about it, the trader is going to look at any news that they see and they're going to trade on that. So if they see Turkey selling, they may say, okay, they don't want the gold anymore, and they may surmise that the price is going to go down. That gold liquidity is the physical liquidity just goes to feed the refineries, right? And it does make more available. You could see some of it come back to the market, but I don't think that amount of tonnage is not enough to, I don't think, move the needle, other than to maybe convince traders in the short term, like on a 2 to 3 month basis, gold may do something, but I don't think it's going to crash the market. I don't think it's big enough. I mean, you would have to see the US say we're selling 8,000 tons. That might crash the market.
Yeah, of course.
That's a lot of liquidity, but that hasn't happened. Well, the thing about Shanghai, if you look at it, there's two markets. There's the futures market, the SHFE, and then the physical market, the SGE. And the reason they have a physical market is because there's a lot of jewelry trade that goes to Hong Kong. There's a lot of people buying gold and silver for dowries and celebrations. Gold and, to a lesser extent, silver are a huge part of Asian culture, especially in China, but other parts of Asia. And so they have a more physically delivered market to facilitate that. And then they have a futures market. And if you look at what happened on the SGE, it's dumped a bunch of metal. And at one point, it got sort of to a danger zone where they're like, are we going to have the metal to support the market? I mean, that was closer to a force majeure, because SGE is actually a heavily delivered physical market. You could have a closing in the market if you run out of gold there. Futures, not so much. It's just a futures contract. But on the physical, so what you see happen is that China's being drained, and it pushed up premiums because they were running lower, supply and demand, basic economics 101. And I think that caught the attention of people when it was more than a couple of $3. When it went from $2 to $3 to like $10 and $11 an ounce, on gold, and several dollars an ounce on silver, then all of a sudden you're like, well, whoa, what is that market doing? China by itself is not big enough to take control, but I personally think that if China and the BRICS all join forces, then they're going to have huge amount of say in what the gold and silver price is. And again, this goes back to the prediction I made on your show last time, is that we're regionalizing our commodities markets, not just gold and silver, but oil. Think about oil. Think of the current conflict in Iran and why it would be important to have different markets for oil. Does everybody need to trade on the WTI or the Brent? No, different parts of the world may have different risk premiums because of what's going on, and depending on how they get it. The people that are most affected by the Strait of Hormuz closure are going to pay higher prices. So I think commodities are going to regionalize, and I think economies are going to regionalize. One thing I'd like to point out, one of the reasons why the U.S. price is not caught up to China is because the refiners are all full and you can't get the metal over. So to arbitrage a trade, there's a paper and a physical element. But the physical can't move right now. There's not enough. All the refineries are booked. There are tariffs all over the world for moving the metal. Nobody wants to move it. And so because demand's higher in China and you can't arbitrage that with metal elsewhere, then the price in China is going to stay higher. And it's going to attract people's attention. And it's going to show people that you can have higher prices in metals when you actually tie to a physical market, which China has, more so than the US has. And I think that's the good illustration. But I think long term, what I really see is once that BRICS market emerges and you have that what I call the super precious metals market, now we're talking China, Russia, Brazil, India, South Africa, and the rest having a tremendous amount of market pricing power. Now, it may take them a couple of years really to get that built out. I mean, it's a lot of work you got to do to build a market, and everybody, puts the systems in and the rules and all that. It takes time, but it's only probably a few years away. And China is probably just like a canary in the coal mine of, we need better pricing markets and we need more regional markets. And in some point in time, countries are going to have to take the tariffs off of metals. Because if you don't take the tariffs off of metals and you can't move it around the world, then each of these markets is going to collapse into only a regional market. So if you can't ship gold from the U.S. to London and vice versa, those markets don't line up anymore. They split into more regional or local markets. Markets local to who can actually trade. And I think that is coming. And I think anytime you have war and geopolitical conflicts and you have financial issues in which people are slapping tariffs and blocking exports and doing financial controls, which they all happen at the same time. The war and the financial controls always happen at the same time. That's going to split and break up the commodities markets, which if you're not a fan of COMEX or London OTC market, you're cheering at this point because you're like any other system would be great. So I think we're moving there for sure. 100%. There is sentiment in the market that can move the price. Silver went to 121. I think gold was at like 55 somewhere, 55.41, something like that. And then on January 30th, we had the big crash. And silver intraday was down 36%, but it ended down 31 at the end of the day. And gold was a lesser percentage than that. Silver really took the beating more than gold, but they both went down and they've been trading down almost since January 30th. Today, they're up a nice little bit. Gold and silver, a nice little pop. Gold's up 100 something bucks. But, those have been incremental sort of movements. And so the big question is, what happened? And I would say that, I did a video last night, and on January 30th, there was a basically long clearing smash. Now, and I'll get into that in a minute. You could say that some trader somewhere lit the match that started the forest fire, that lit the match in a way in which they could get the outcome they wanted. Maybe they were spoofing prices on the exchange. We saw the fine of JP Morgan, 920 million, doing that back in the day, a few years ago. We've seen other fines come out to market participants. I've interviewed the lead investigator who was on that JP Morgan case for the CFTC, and I have a bit of inside knowledge on how that works in that interview when we were at Silver Symposium. So essentially somebody could have lit the match, but it was going to happen anyway. I mean, the markets had gone up too much. And the reason we look at technical analysis, Lucian, is that we want to know where the prices could go because traders are trading on technical analysis. They're trading where gold's going to go. It's kind of like what Wayne Gretzky says, famous hockey player. He said, you skate to where the puck's going to be, not where it is. That's the futures market. They're skating to where they think the puck is going to go, where the price is going to go. Where's gold, silver going to go? Where's oil going to go? Well, I'm taking a bet short or long. And so what happens is the bets had been long for so long that there were some people who are like, okay, I'm ready to close out my position. And when the prices started falling, there was a big margin call. And I explained this in my video last night by walking through the rules of the COMEX, and then using January 30th as an example as to what actually happened. And in silver, there were over 8,100 contracts of 5,000 ounce silver that of open interest that closed on the 30th, meaning people were closing positions. And this is something that people may not understand. You can open a position and close it 2 seconds later, and you're only out the price exposure you had for that time. So people think that, these bullion banks are hugely short the metal. They are for themselves and other people, but they can close those positions out. And the settlement is determined daily. So the market clearinghouse, the CME's market clearing mechanism will automatically say, okay, you were long a contract of gold. You lost $5,000 today, pay it. And it comes out of your margin. So this is why the exchange itself doesn't bankrupt every time you have big moves either way, is because the players are putting up margin to the contract, and that's what pays out, and they pay daily. It's like you go to the casino, you make your bet on blackjack, you win or lose, and you cash out. It's the same for the people on the COMEX. They win or lose daily. And once their maintenance or their margin gets down close to zero, the CME group just automatically closes them out. They close that contract out. They're not going to let you default, and there's an insurance fund behind it. So the exchange is not going to default. There's not going to be a force majeure in the way that people think. Now, you can be a crash. There can be a liquidity crash. They can run out of physical, maybe not enough ounces come on for actual deliveries, which is a very small portion of the trades where you actually do the physical. Most of it's just paper betting. But essentially what happened, the trade had got too heavy. Some people couldn't handle the action. They ran out. And so there were margin calls, and then crash. And the algorithms that trade the market for some of these big players saw the price falling and they sold. So some of it was margin calls where people ran out of maintenance and CME Group said, you're done. You're on the wrong side of this trade. You were short, you're done. So the shorts closed. But then there was a lot of longs as the price began to fall. They ran out of maintenance because it was falling 31% a day. That's why so many contracts closed. those contracts auto closed because they ran out of money, and the CME group's not going to go, they're not going to say, okay, use your credit card or pay us in 30 days. Once the money on deposit's out, that position closes. So when you have prices falling and you have open interest rising, that's people introducing new short paper. That's not what we had happen. We had open interest falling and price falling, which is the longs are being cleared out because they're losing money because the price started to fall. Why did the price start to fall? You had this almost euphoric 18